Welcome to another video. I wanted to take a closer look on call option moneyness. Let's dive into it. I train elite seven-figure traders on how to use powerful techniques to take their trading to the next level. I'm building this channel for those of you who aren't seven-figure traders yet, but want to learn and implement elite strategies to optimize your returns on your favorite ideas while managing risk like a pro. We've explained how call options work, but I want to get into the concept of moneyness. Understanding the moneyness of options is critical because at a basic beginning level, a lot of investors mistakenly make the decision saying an option that's trading for, let's say, $1 is cheap and an option trading for $30 is expensive. And they think that, well, if it's only $1, I can buy 30 times as many of those options that I bought of the $30 one. And therefore they don't account for risks, probabilities associated with the option pricing. This needs to be further explained, and it's really important for people utilizing options to start to understand. An option is broken down into two components. It has a time value, and sometimes it has an intrinsic value. Now, what is this time value concept? Time value is actually the premium paid for that right. And so when we secure the right to buy a stock in the future, the counterparty needs to receive an income or a premium for giving us that right. They're not going to do it for free. And so the time value component is the premium inside the option that is paid for securing that purchase price at that strike price. Now, when the stock is fluctuating higher or lower, it may build an intrinsic value, but the intrinsic value is actually equity that is being built inside the option price. The two most important things to remember is intrinsic value reflects the real equity and does not erode with time. And intrinsic value inside an option is directly related to the value of the underlying security. If I have secured a $100 purchase price on a stock and it's trading at $150, at any one moment, I can exercise my right to buy it at 100 and sell it at 150. That $50 difference is an intrinsic value inherently built inside this option. Now, calculating an intrinsic value is simply by taking the stock price minus the option's strike price. Now, when you do that, if that number is negative, then it obviously is not in the money. And if it's a positive number, that's the dollar amount of intrinsic value being built into this option. A very simple example of this, if we have that stock that's trading at $20 and we have a $15 strike call option, so the right to buy it at $15, we know that that intrinsic value is the $5 like we calculated earlier. Now, if that option is listed on the options exchange at $6.50, then we know that $1.50 of that is the time value and $5 is the intrinsic value or equity inside the participation of the upside of the stock. So depending on where the strike price is relative to the stock price, in the options market, we categorize all options into three states, either out of the money, at the money, or in the money. And so when an option is in the money, it has an intrinsic value. When it's at the money, it's the strike price closest to where the stock is actively trading. And out of the money are all the strike prices higher than where the stock is trading. So when we look at an example here of Microsoft, which at the time of this quote was trading at $422, we can look, there are strike prices as low as $400 here on the screen to as high as $450. So what we can see is anything that's north of $422 is out of the money, and everything below $422 is in the money or has an intrinsic value. And the closest option strike to the existing stock price is $425, which we would consider the at the money option. So why does this matter? Well, a lot of very basic traders make the assumption that an option can expire for an entire loss. And therefore, when they look at whether or not it's a $50 deep in the money option or a $5 out of the money option, they assume that that option can expire worthless and it's all risk capital. But that's simply not the case. The very deep in the money options will have an inherent intrinsic value built into them that doesn't decay. Obviously, a stock could decline, but that would be a loss to both a stock investor as much as it is to an options trader. All that matters is how much time premium that you paid for the option, because that is actually the cost of using the optionality of an option. At the same time, the deeper you go in the money, then the option literally starts to behave like the stock. And that's where investors seeking that kind of a strategy are leveraging the equity that's being built in some of these very deep in the money options. Well, thanks for watching, and we'll see you in the next video. Cheers, everyone.